Have you ever wondered why shares do not jump 50% or 100% in a day? This sounds exciting, right? This would mean that we investors could double our money overnight. But at the same time, the question arises, what stops shares from falling by 50% or more in a single day? This is where circuit limits or circuit breakers come into the picture. Welcome to Bullsmart. Today, we answer these interesting questions and introduce you to the world of circuit breakers in the stock market. The stock market can sometimes be a roller coaster ride. At times, the prices of shares tend to move wildly. This is because, like any other market, the forces of demand and supply impact the stocks and the market as well. A stock that has demand exceeding the supply increases, and on the other hand, a stock that has its supply exceeding the demand sees a fall. But then what happens if the demand massively exceeds supply and vice versa? This is exactly where circuit breakers come in. In the context of the stock market, a circuit breaker is a mechanism designed to prevent extreme price swings and sudden crashes. A circuit breaker is a regulatory measure that suspends trading on the exchange. Circuit breakers work with predefined values to control volatility in the markets in either direction. Now, let's understand what we mean by the upper circuit and lower circuit. This is a price band including the upper limit, known as the upper circuit, and the lower limit, called the lower circuit. These are the highest and lowest prices that a share can trade on a particular day. If either limit is touched, trading is halted for that day. As for the BSE and NSE circuit rules for stocks are predetermined for 10%, 15% or 20%, the levels depending on the stock and the index. However, stocks with listed derivative contracts or parts of indices with derivative products do not have circuit limits. In the case of illiquid stocks, the exchange may even reduce the limit to 5% and 2%. This brings us to the next question. For how long is trading halted if the circuit limits are touched? Here, the duration that a stock is halted depends on the type of circuit breaker, which we will take a closer look at later. These, however, can range from 1 hour to the rest of the trading session. Indexes have circuit limits too. Now, let's take a look at the real example with circuit breakers in action. In March 2020, the coronavirus scare resulted in the Nifty 50 crashing by 10% in the early trade. This triggered the circuit, resulting in trading being halted for 45 minutes. This was the first time when the Indian market has been halted in 12 years. But once trading was resumed after the markets were put on hold, the Indian markets recovered. This also helps us understand the benefits that circuit breakers have for Indian markets. The benefit that we have is investor protection. Circuit breakers are there to safeguard investors from rapid and extreme price swings that can lead to huge losses. By pausing trading, they provide a cooling off period that prevents panic selling or buying. The second important benefit provided by circuit breakers is the market stability. They help maintain overall market stability. Sudden, uncontrolled crashes can lead to financial crisis, and circuit breakers act as a stabilizing force by limiting extreme price movements. Finally, circuit breakers also help prevent panic, just as seen in 2020. When circuit breakers are triggered, it gives investors time to think and react more rationally. It's like hitting the pause button on a frenzied market, preventing rash decisions. Now, let's look at the type of circuit breakers. The different types of circuit breakers can be put into 3 categories if they fall by 10%, 15% or 20%. In the first stage, if a stock has 10% movement either way, then the next aspect that is looked at is the time that this happens. If this happens before 1 p.m., then trading is halted for 45 minutes. If this 10% movement takes place between 1 p.m. and 2:30 p.m., then trading is halted for 15 minutes. And if this 10% movement happens after 2:30 p.m., then there is no halt put on trading. Now, let's look at the next stage. If the stock sees a 15% movement before 1 p.m., then trading is halted for 1 hour and 45 minutes. In the case where there is a 15% movement at or after 1 pm, before a trading halt of 2 pm and 45 minutes of 15% movement on or after 2 pm, the trading halt is for the remainder of the day. And the last stage is a situation where the stock sees a 20% movement either way. If the stock sees a 20% movement, then trading is halted for the remainder of the day. Trading resumes after the halt period is completed and business is conducted as usual. Circuit breakers in the Indian stock market are like the speed breakers on a financial highway. They are there to maintain order, protect investors, and prevent wild price swings that could lead to panic. If you find this video useful, check out our page where we post more useful and interesting stock market content.